financial economics suffered huge losses while falling under the illusion that it could control all market movements by quantifying them and generate low risk and high returns. The collapse of long-term capital management was a shock to the global financial market. On September 23, 1998, long-term capital management, a huge fund that shook up the U.S. financial world, failed. The members of LTCM were not securities-men with long experience on Wall Street, but a group of doctorates in finance and math and computer experts. The person who led the establishment of LTCM was John Meriwether, the leading American bond dealer of his time, and vice chairman of the investment bank Salomon Brothers. He led the fixed income team pursuing arbitrage at Salomon. Several bond dealers who had worked with Salomon joined LTCM. Merton Miller, a Nobel Prize winner in economics, and other financial experts recruited Merton Miller and established LTCM in 1994. LTCM was a huge fund that pursued high returns through innovative investment techniques by gathering financial geniuses armed with mathematical models and computer programs rather than traditional Wall Street securities men. Nowadays, we are very familiar with concepts such as queens and algorithms, but in the early 1990s, this investment method was very unfamiliar. The investment strategy proposed by Meriwether was relative value arbitrage. LTCM's investment strategy was to pursue risk-free arbitrage called convergence trading using mathematical models and computer programs. By installing a sophisticated program on a state-of-the-art computer, you can capture fleeting moments and make money without much risk by selling relatively expensive assets and buying cheap assets. Of the 16 hedge fund partners, 5 were professors or former professors of finance at Harvard and Stanford universities, and 7 were doctorates in finance who received doctorates in finance and economics from MIT and the University of Chicago. 2 of them were great figures in academia, winning the Nobel Prize in economics 3 years later. They are Professor Martin Schultz, who won the Nobel Prize in economics for his option pricing theory. The 1997 Nobel Prize in economics was awarded to Robert Martin and Myron Schultz for devising a model to determine the value of financial derivatives. The person who came up with this theory was Fisher Black, who worked at Goldman Sachs. he accidentally created an equation by applying thermodynamics and physics theory, but it was not recognized during his lifetime, and he died of laryngeal cancer in 1995. Purpose is that Fisher Black met Myron Scholes, who was a professor at MIT at the time, and complained that his formula was not recognized. Accordingly, Scholes proposed publishing the theory under a common name, and this occasion later came to be called the Black-Scholes model. This occasion is not an economic theory, but a problem-solving method derived from thermodynamics and physics. This model is now called the Black-Scholes model. This model can be said to be a theory comparable to Newton's laws of physics in discussing the price of options. Because of the one price principle, if the assets are of the same type and the issuing institution or a company is the same, theoretically, the value of the assets is bound to be the same or the same. However, intermarket prices are often different for the same assets. This abnormal condition is resolved instantly. Meriwether has used this investment strategy since the first year of establishing LTCM. Their trading methods were arbitrage, short selling, and leverage. This is a method of obtaining the theoretical price of each asset, pursuing assets with relatively low prices, and taking a short selling position on assets with relatively high prices to make a profit. The funds used here were obtained through leverage, that is, external borrowing. After gaining confidence through trading Italian government bonds, they took on new challenge in Russia in 1997. While the value of government bonds in emerging markets was falling due to the East Asian foreign exchange crisis, in 1997, they judged that the spread between Russian government bonds and U.S. government bonds had widened too much. Because of this, they took a position to buy undervalued Russian government bonds and sell U.S. government bonds. But this met with catastrophe. As Russia declared a moratorium, Russian government bonds turned into trash. On the other hand, U.S. Treasury bonds rose in value amid the foreign exchange crisis, putting LTCM in crisis. LTCM, which had a buying position in Russian government bonds, suffered astronomical losses and closed down when Russia declared that it would not be able to repay its debt for the time being. They believed that the probability of their failure was as low as the probability that the earth would be destroyed. LTCM's financial geniuses believed these calculations and did not actively prepare for risks. Meriwether was unable to overcome the 2008 U.S. financial crisis. On July 7, 2009, the liquidation of the fund was announced. Since September 2007, when the credit crunch began in earnest due to the U.S. subprime mortgage, non-prime mortgage loan crisis, the company has lost 44% of its original balance in a year and a half. That is just as bad a return as when LTCM was in trouble. A person who was recognized as a financial genius ended up being criticized for being unable to keep up with the changes in the market and eventually degenerating into a financial darlot. Afterwards, LTCM becomes the subject of public ridicule for failing to invest in stocks despite having numerous financial geniuses, including two Nobel Prize winners and 6 PhDs from MIT. The vice chairman of the Federal Reserve Board, who was strongly mentioned as the next successor to Federal Reserve Chairman Alan Greenspan at the time, also participated as a partner. In the end, the U.S. Federal Reserve took action. Greenspan, then chairman of the Federal Reserve, lowered the benchmark interest rates over a period of 7 weeks and hurriedly provided funds to LTCM. About 20 commercial banks and investment banks participated and provided $3.65 billion to fund the acquisition and restructuring of LTCM. As a result, LTCM investors received some, if not all, of their funds back, and LTCM was finally liquidated in 2000.